My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour, Vincent Cignarella, who I have not seen in probably 8 years. I think we were at some kind of conference, I think for the CMT Association when we last chatted for a bit. But Vincent, for those who are not familiar with your background, talk about who you are, how'd you get involved in markets, what's your specialty, and how was it working at Bloomberg?
Sure. From the beginning, I started trading FX and rates in 1982. So when people talk about is this Volcker's inflation, one of us at least is old enough to know it isn't. I moved on from trading a prop at a bank to trading at British Petroleum, money markets and FX for them as well, and was part of their acquisition of Standard Oil. From there, they moved to Cleveland, and I did not. And I went on to become a general partner at ICE. Moved from there to go back trading for a bunch of years, and then went to work for the Wall Street Journal as a columnist and a lead blogger on their new venture at the time, which spoke directly to traders. And then I was recruited by the former head of Bloomberg Breaking News to come to work for them. And it's been, 9 years now. And what I do now, if any of you have a Bloomberg terminal and if you have any interest, there's a product on the terminal called Squawk. And it's simply just SQUA Go. And there's a macro channel and an equity channel. And I speak to traders all day, both in IB and phone calls and whatever have you, emails. And I talk about markets all day and what I see, news coming out. And so I'm monitoring Twitter, a variety of different news feeds, and basically just another pair of eyes and ears for traders out there who don't have that much real estate or can't use that much real estate up on their screens. So that part's been fun because it's kept me in touch with people in the market. And it's such a really high, fast pace part of the business being breaking news. It almost feels like trading again, which I'm really not allowed to do. So I get my joy, I suppose, my kicks out of that. And that's about it. Bloomberg's kind of an up and down place, to be honest. I was doing hosting radio for a while as a guest host. But I guess as things go, I just couldn't spend that much time, 4 hours a day, 5 days a week on the odd occasion away from my basically day job. So now I just do occasional hits, occasional radio. And if you're in Canada, I do a regular piece at about 3:45 on Bloomberg Television every day. And that's me in a nutshell.
Yeah, no, that's right. Okay, so a few directions I want to go with this. So first of all, you mentioned that you speak to traders with the Squawk, these daily kind of Squawk conversations. There's this impression out there, Vincent, that traders have a better sense of what's going on, maybe than investors, because they have to have a shorter time frame and are actively trying to look for opportunities. It seemed to me that this year it's almost like the exact opposite. That traders really have no clue what's happening because there's so many conflicting signals. I'm curious to hear what's been the feedback among those traders that you speak with. Is there a degree of confidence? Are people confused? What's sort of the broader sentiment that you've seen across the trader community?
Yeah, that's a really good question. I think the investors are beating the traders out this year because the volatility's really picked up, and it given the geopolitical landscape and given what the Fed is up to, and especially with the bills that are still on the table in Washington, I think volatility, at least for the rest of this year, is here to stay. And a lot of guys are getting beat up pretty badly. Not that they're not making money, but yesterday I think was a great example. After we saw the jobs data and the market sold off, the first guy who came on to me was like, "I'm selling risk," and I was like, "Please, not here." This is going to end up in the green. This is a Friday. People are going to cover and going into a weekend. I mean, that's the kind of thing that I do and speak with traders. Obviously, I'm not right every day, or I'd still be doing it. But I think that volatility's hurt a lot of people, and the investors in the long run are making a better go of it. And I expect that that's going to continue going especially into the fourth quarter.
The interesting thing about that is that I think the real frustration, you mentioned the trader talking about reducing risk, and the issue is that If you reduce risk and you position into the areas which tend to benefit from higher volatility, like treasuries in particular, uh, it seems to look like equities, right? So it's almost like
Yeah.
all risk is correlated to some way in a way which is not normal in historical tail events.
No, yeah, and I'll share something with everyone, and all correlations eventually break, but this one's still going. I think it was somewhere in mid March that I kind of tripped over this. Better lucky than good is my career in trading. I've always taken that. There's been a very good inverse correlation between the S&P 500 and the dollar. And the dollar I look at is the Bloomberg Dollar Index, simply because it's broader, it covers more currencies, and it's been a really good crutch to lean on from a trader standpoint who, as you mentioned, really maybe even 1 or 2 day time horizon, if not 1 or 2 hour time horizon. If one moves and the other doesn't, there's a reasonable possibility the other will to catch up, or if it doesn't, that the one that's moved higher or lower is presenting an opportunity to fade that last move. So inevitably, the two seem to continue to sync up. I expect at some point, like all, it's going to break down. But that volatility, yes, you mentioned it, treasuries as well. It's the same. It's the same exact thing. I mean, you look at the way the 2 year and even probably more so the 10 year is traded. 80 basis points off the highs in almost what feels like a blink of an eye. Um, Not what fixed income traders are accustomed to at all.
Right, and that's so. Let's go with that on the currency side because you mentioned the experience on the currency end, and this is one of those really strange dynamics where the dollar has been strengthening for a while now. Right, you really talk about I think February, March of last year, and I've made this argument before that you often tend to see signs of potentially a sovereign debt crisis first through currency movement. Um, I've had a lot of different guests on these spaces, and many will make the argument that this move in the dollar has been justified. But it seems inconsistent given inflation and given this narrative out there that there's so many dollars, but it seems like there's not enough to go around for everybody else.
It's The dollar's been a conundrum, and that's because I think at this point, when you look around the world, it gets really, really hard to see where you want to be. So just stick for the G10 space for the moment. The Swiss market's not really big enough to give you too much opportunity, and the Swiss National Bank has a tendency to spank people pretty badly on occasion. I've been on the wrong end of that. Not a lot of fun. Yen is a really tough place to be right now for two reasons. Really being the tail being wagged by the interest rate dog, where treasuries go, and the volatility in treasuries has been tearing up the yen, and also now the geopolitical risk with China and Taiwan. If something untoward would happen, you don't really want to be invested in Asia because it's impossible to know what that could turn into. And then you have the situation in Europe. Ukraine isn't going away. There's strong speculation that Putin wants to continue this into the winter and then really squeeze the Europeans. And I think the euro, especially, is someplace you don't want to be. And typically, I would say, as a former trader and in the rate space with the Bank of England raising rates, that would be an alternative. But they've got a really importing really fierce inflation, and they are still in the Brexit situation. They haven't sorted out their trade situation, and they, of all the G7 countries, maybe with the exception of oil with the Japanese yen, they import inflation, and it means it affects them much more than many others. And given where the supply demand situation still is, I'm not comfortable yet being in the UK and being in sterling and being in gilts just yet. I think there's more to go, but inevitably, I think the UK bond market is going to present a nice opportunity at some point because their rates could easily outpace where the Fed is.
Okay, and this is an important point I think for the audience to explain sort of the link between currency movement and the direction of inflationary pressure, right? So in other words, weaker currency is a way of importing inflation, stronger currency is a way of exporting inflation. Now, what's kind of interesting about the dollar and commodities here is that commodities have been incredibly strong with the dollar very strong, and I'm fairly certain that's a relatively rare dynamic.
Yeah, I mean, typically that is an inverse relationship with oil and the metals, for instance. And some of the soft commodities, you usually see that relationship going in opposite directions. But this post-pandemic geopolitical situation has really created a situation that we've obviously never seen. And that's why I always push back when people say this is 1970s inflation. It's nowhere close. Um, I'm old enough to remember being on the gas lines with the odd even license plates back then, and unfortunately, my car got 11 miles to the gallon. So I was on those lines quite often. There's the the inflation that we had in the 70s and how that weakens a currency, for instance. So runaway inflation is not good for currencies. You get that impression that it might be because rates go higher, but the inflation eats up your rate of return. So if you have modest inflation and a spread between inflation and rates, so you have a real return, it's really positive for a currency. We saw that with the dollar at periods in the 90s. And then if you look at the same period in the 90s with sterling and when Soros took it to the Bank of England, you had a situation where the currency was under so much pressure, the real rate of return didn't exist. And even though the Bank of England put rates up to historically high levels, they could not defend the pound. So the difficulty comes in when you look at rates and a currency. It's really just one part of what moves the currency, and it's also one part of what moves the fixed income market. There are so many other things that come into FX and what moves a currency that we've often said to people, when I was on a proper major desk, I worked at Chemical, which is basically now JP Morgan. There are times you can come in on a Monday and tell people the reason why the dollar is up is X. And no, I know it sounds astounding, but on Tuesday, you could come in and tell people the dollar is down for the same exact reason, because there are so many other things that are playing into it.
And I've seen stats on this. I'm sure you probably have too, if not done the work on this, but that, you can equate a certain percentage appreciation in the dollar to a certain number of basis point hike equivalent, right? The dollar itself does some of the work that the Federal Reserve does, which is interesting because that would suggest there's been a hell of a lot more tightening of financial conditions just because of currency movement than Powell's movement.
Yeah, so the back of the envelope math, and talk about this with rates traders and such, is, if I could remember this correctly, I think it's something about a 10 big figure move in a currency equates to, there might even be a 4 big figure move in a currency equates to 25 basis points in central bank change, either up and down. So you look at a situation where the euro went from 120 to par. And at 20 big figures, amounted to 125 basis points of increased, if you would, inflation that Europe is now importing because of a weaker currency. And so those are things that a central bank has always been, I don't want to say impotent to be able to deal with, but really difficult to deal with. There's been countless devaluations of currencies over the years, simply because as soon as the markets smell blood, they just go for it. And it's incredibly difficult for the central bank by itself, just one, unless you have a coordinated intervention, which is multiple central banks or multiple treasury departments coming in to support one or two currencies combined, because it generally benefits the group. In and of itself, as you mentioned, that's a really good point. A lot of people don't know this, that the currency movement does equate to the equivalent of interest rate changes. And yet it's also something difficult for central banks to comprehend and to be able to deal with them.
Yeah, that's going to have a lot of interesting implications on whatever the ECB does going forward. So we'll hit on that in a second.
So I do agree with you. First of all, the fixed income market, for all of my experience, they were the smarter guys in the room. I think what you're seeing, and you bring up a real...
Oh, you said were, which is interesting. I don't know if that was a slip of tongue.
Okay, so I think what we're seeing in the markets, and I do think right now, I do, with all respect to the fixed income guys, I do think the Treasury market right now has it right, and I think the Fed has it wrong. When you talk about that inversion, and this is a good point, what people are thinking about this as a precursor to recession, and it's very possible that that is the case. But I think more so, And if the recession comes, the recession comes. But this is more of a situation where Treasury markets and traders just don't believe the story the Fed's telling them, or central banks in general are telling them. They have to keep the 2-year part of the curve and shorter close to where the Fed funds rate is. They don't want to create an arbitrage in that situation where you have negative carry on your position. But when you look at the longer end, and as you mentioned, the 20s, the 10s, out to 30s, basically anything past 5 years, I think, you're looking at fixed income traders that are betting that these interest rate hikes are a short-term phenomenon. And that's why you have the inversion of the curve. Nobody thinks the Fed is going to go to the places where they say they're going. The Bank of England the other day was talking about something like 13%, I think. The central banks, in my opinion, and I'll just concentrate on the Fed because I know that one better than the others. There was clearly a policy error, and they've all admitted it, about the transient inflation story. So now you have a situation where inflation is perked up. They're chasing a bad policy mistake with what I think is another policy mistake. We're going to get inflation numbers next week. They're supposed to show inflation coming down very nicely. I think when you see a situation where they've tried to curb demand, which is fine, but it takes 6 months for monetary policy to move its way through the economy. They're going at breakneck speed and not giving prior decisions an opportunity to affect economic change, to bring that demand down to where the supply is. I think if they left well enough alone past September, I'd prefer actually they don't even do anything in September, but it's clearly they feel a credibility issue at this point is what I think it is. They're all afraid to be called Burns, which was the disaster chair of the 70s. And I think that they will come to their senses come past September, because I think inflation is going to come back down sharply, because frankly the consumer just doesn't have the spending power. We had revolving credit numbers out on Friday. The credit card debt of consumers is at levels that is now above 2008, and we all know how that worked out. So I think the consumer is closer to being tapped out than people think. And I think that demand will shrink and it will match whatever imbalances are left in supply. And that's going to take the foot off the pedal for central banks everywhere. And I think the Fed will probably be the first one to see it.
And by the way, this whole narrative of the Fed hiking rates, continuously, or even the whole narrative of, they need to get to like an 8% or to 9% based on Taylor rule. I mean, that's nonsense, because you got $30 trillion of U.S. government debt. It's remarkable to me how people don't consider the context under which rate hikes are occurring when your starting point is already so levered.
Yeah, and think about the other side of that coin is you still, even after they quote unquote quantitative tighten, are still going to have a $7 trillion balance sheet. So, to me, the smarter move for the Fed would be to almost do a reverse operation twist, bring the debt into the short end, or bring the balance sheet rather into the short end of the curve, which is where they belong, which is where they've always been, and let that debt roll off when it's time to take money out of the system, reinvest it when it's time to put money in the system. The Fed, I looked at this the other day. I have to look at my notes, but it had a 9 in front of it. Since January of 1991, in the Greenspan era, I'll give you 3 seconds to just take a guess. How many times do you think the Fed changed the Fed funds rate, either up or down?
It is, I don't know. It's a good question. Go ahead.
Okay, 91 times.
There you go.
How kind of ridiculous is that the Fed felt they needed to do these 25% tweaks 91 times to bring monetary policy in line with the economy?
Well, you said you talked to traders. I mean, they're trading rates for the economy. They're traders too, just in a different way.
Yep. And so I just think and in fact, I think if you look at the average Fed funds rate over the same period of time, it comes in at around 2.5%. And what people don't realize is this 2% inflation target was really a creation of Alan Greenspan. As he used to say, I get my best ideas in the bathtub. So one day he was in the bathtub and decided inflation should be 2%, and every central bank adopted it. And if you think about it in a bigger picture, suppose the economy was running fairly well with inflation at 4%. and it wasn't running out of control. There was no wage spiral. Growth was solid. What is the position or what is the point of the Fed now raising rates past the inflation rate to slow an economy that's working just fine? It's really not their mandate.
Oh, I noticed that some people left the space because they started picturing Greenspan in a bathtub. Just to be
Yeah,
clear,
that image has never left me. I'm sorry to share that with you.
that pretty much ruined my weekend. Let's.
I'm hoping that the Fed sticks to their mantra, which is that they don't allow one number to alter their thinking. I'm afraid this one might a little bit,
Well, I mean,
but
the long duration side acted pretty violently on Friday,
yeah,
to my
yeah.
chagrin.
Then, and the other problem with the jobs numbers, frankly, is everyone from Mester on down seems to forget that jobs are a lagging indicator. So I expect jobs to continue to stay strong as we come out of this pandemic cycle. We're just back at the jobs that we had prior to the pandemic. We've not really added as many jobs as the administration says. We've really just got them back. So when you look at the gains in the job numbers over the course of the last 2 years, we're really just getting back to where we were in, say, January of 2020. Going forward, I would expect that to change dramatically over the next 6 months, and I'd expect those job numbers to slow. As Mr. Goolsbee said the other day, we don't have that many people to keep creating 500,000 jobs every month. And without question, that's going to go down, and markets are just going to have to accept that perhaps 150,000 jobs created every month is much more normal. And I think when you get to the tail end of the cycle, we're going to see those jobs come back down, and they really shouldn't be forward guidance when they're backward looking. That's just my opinion.
So, by the way, that's actually a good transition to something I wanted to have you talk through, which is labor in the context of not just jobs, but obviously the labor force participation rate, the discourage to workers, and how that is sort of complicating things. You kind of alluded to it with the 500,000 jobs there, but what's going on with the labor force participation rate, and why is that potentially sort of a confusing variable in thinking about the state of the jobs market?
Yeah, typically it's something that gives you a clue as to people seeking jobs, and how much the health of the jobs market. But it's really difficult to try to get a handle on what the last 2 years have done to the employment base. I think it's just a little too soon to look back at older models to go forward and say this is what this really means, when the entire economy and the entire jobs market was thrown into sort of a helter-skelter with the pandemic. I mean, there are a lot of people that are just not going back to where they were. A lot of people are trying to work from home. And I don't know that the participation rate going forward is going to give us the clear picture of health or not health of the U.S. jobs market that it did in the past. It's going to take a while for that to sort of play out. I know hopefully nobody on Bloomberg's on, but I've been working from home for 2 years, and my production has actually increased. When I do the Squawk product, I can't do radio or TV because I have to leave my desk for someone to sit in my chair. I can do that from home and do those two things at once because I don't have to go anywhere. I'm doing it right from here. I think a lot of people have found that same situation. And so their ability to participate or not participate in perhaps jobs they had before, or even just work part-time because they found other avenues to make money. It's just I just don't feel comfortable with it as an indicator. I mean, maybe it's me, but it's just not my favorite one to look at these days.
Yeah, no, I agree. Because the nature of the data has changed. I think is the point, right? So how do you really know if it's not even garbage in, garbage out? It's almost a different type of data.
It's hard to compare it to a
Right.
prior year. I mean, I've argued for years when every Fed forecaster and such, when you talk about the Taylor rule, and I can't think of the other one off the top of my head, which is my favorite, which is long since dead. These things have never actually applied to reality. And so until we get back to a more normal situation, I think a lot of the models that people are looking at now really have to be rethought and rejiggered a little bit, because I don't know that they speak to the future as much as they speak to the past, and that's not going to be very helpful. I think they should be. Do I think they're accurately in there? No. It's the same way, if you look at, this is probably a bad analogy, but when you sort of look at the positivity of COVID, we don't count the people who take the test at home and never go to a public place to be registered. I think there are a lot of people in an underground economy now that much more so than in the past are quote unquote potentially working off the books, potentially working part-time and then part-time in a different sort of cash-like situation that aren't being counted. And as far as whether we're in a recession or not, I'm going to have to stick to the point where unless they change what it says in the textbooks, that we are in a technical recession. Does it feel the same way? No, because we're in a different situation. Will it continue going forward? I can tell you that if the Fed continues doing what they're doing, inevitably it'll happen. If you look at the last 50 years, and I actually did a blog post on this Friday, a trader gave me this line, so I had to steal it. The only soft landing we've had in the economy in the last 50 years was Sully on the Hudson River. In every single economic cycle, when the Fed hiked aggressively, a recession followed. Now, the good news, after that recession, we saw a really robust positive equity and bond market, and generally speaking, a robust and positive and healthy economic environment outside of the early 80s with the inflation scenario. So I almost hope we're in a recession because I feel like the sooner the Fed gets us there, the faster we'll get out and the better off everybody's going to be.
But I will say that when you look at overlaps of recessions and where the S&P is relative to its 200-day moving average, usually when you're below a 200-day moving average, you're in a recession, even if the NBER hasn't formally announced it. So there are market indicators that would suggest you're pretty much there, maybe have been there for a while outside of the technical, negative 2 quarters. Although it's interesting because I had Lakshman Achuthan a couple of days ago, and his point was that, well, really a recession is not 2 negative GDP quarters. It's a prolonged period of deceleration. He had a very specific way of framing it that left room for some degree of interpretation. But practically speaking, whether it's recession or not, it doesn't matter. What matters is price movement.
Yeah, and exactly correct. It is totally what price movement is, and I think, it depends on who you speak to. You get somebody like Fed President Daly who says, "I'm not feeling it. Everything's fine." You're probably in the 1% of the income bracket, so you're not going to feel it. But the individual, the people in the grocery stores who are on paycheck to paycheck, that move in gasoline prices is felt, and I think we're going to feel it even more when we get into home heating in the winter, both here and in Europe. So if we're not in a recession now, wouldn't surprise me if we trip into one as we go into the end of this year. But I personally think that's positive for risk. I think what has really hurt risk over the last couple of months is when the Fed first sort of pointed to the fact that they were going to begin a hiking cycle. I think once they get to the point where they stop, barring any geopolitical risk, which there's tons of it out there still, if that sort of settles it and the Fed backs off a little bit, I think the economy can come out of it extremely, extremely well. But we need to look at the U.S. consumer. As I said, the revolving credit cycle is really high. If you look at the savings rate, everyone keeps saying the balance sheet of consumers is great. It really isn't. Savings is back to below pre-pandemic or at pre-pandemic levels. So all that stimulus has been either spent or what have you. It's certainly not saved any longer. It looks like the consumer's tapped out when it comes to credit card debt. And where they're going to go next is going to be interesting. One really smart guy a couple of weeks ago told me that the next major indicator to see where the economy is going is to look at auto loan defaults. Because people need their cars no matter how little money is coming in to get to whatever job they have. And so they'll skip a mortgage payment or a rent payment before they'll skip a car payment because it takes a long time to kick somebody out of their house. It doesn't take a long time to repossess a vehicle. So that might be the next canary in the coal mine if that should start rearing its head. I don't watch that as closely as maybe other people do. And again, goes back to what I was saying before. I don't know that certain indicators of uncertain models of recession going forward are as good or as helpful as they may have been in the past because things have just been screwed up. It's very, very likely that that has always been the perfect indicator of recession, because if you look at it from history's standpoint, whenever you've seen an inversion in the short end of the curve to the back end of the curve, it's occurred for two reasons. One of the primary reasons back before the euro was when countries were trying to defend their currency. And so they raise rates in the short end to try to make it very, very difficult to borrow. And then the curve would invert and would stay that way either till a devaluation would happen or the central banks beat up the markets. I think in this situation, back to what we were saying before, I think the inversion is more to do with all due respect of Mr. Powell and the FOMC, the market's not feeling that this Fed is that credible. I think they really, really believe that this Fed will not be able to raise rates to the levels they think they will say. And in the long run, that won't be the case. And I think if you look at sentiment indicators, past the 1 year, they seem to be declining. And I think the consumers basically agreeing with the market to a certain extent that, past this year, I mean, market, I believe, is still pricing in cuts for 2023. That past this year, that people just don't feel, either traders or consumers, that rates can stay this high and that the rate of inflation will stay this high, because they don't feel the economy is going to be that strong, and that may very well cause a recession because of that sentiment, and may make that indicator 100% correct. And more times than not in the past that was the reason. But I'm a little reluctant to bet on it simply because of that. I think it actually might be more chance that it causes a recession than it is actually the reason for it.
I would add to that also that I think this is also important when people talk about signals. Just because an inversion historically tends to precede a recession, it doesn't mean that every recession needs an inversion. Right? I mean, Japan's a good example of that. I mean, Japan's had several recessions without any inversion. So there's always going to be these kind of false signals. It's just like when I frame lumber relative to gold or utilities against the market as a historical indicator. Usually prior to major crashes, corrections, bear markets, those areas will warn you in advance. Lumber's weak relative to gold, utilities are strong relative to markets. But that doesn't mean that if lumber is weak, it's guaranteed that you're going to have a crash. It's that when you have a crash, lumber tends to already be weak because of that tie to housing. Now, on that point, let's talk about housing for a moment, Vincent, because there's this divergence, which is, I think, pretty remarkable happening here in terms of equity market movement and lumber prices. And I've made the argument for a few months here that housing is just getting started in terms of its own deceleration or bear market. And, maybe the equity markets are not forecasting how that could be a big headwind going forward. How do you view the interplay of real estate and housing and, affordability there to risk sentiment for equities?
I think that's a really good point that you bring up, both in the lumber sense and in the housing market, because, realistically, the average consumer sees their wealth in their equity in their home. The majority of folks in this country are not necessarily vested outside of their pension funds, perhaps, in the equity market. So they feel it more when they see prices go up and down for their home. Now, about a year or so ago, and throughout the pandemic, it was insane here in Westchester County, where I live. People were paying above ask, multiple offers, like crazy above ask. And there wasn't a lot of inventory. And so that complicated the situation as well. And so there was a real feel good about the housing market and a real feel good about risk markets, including equities in general. That's beginning to slow. And you make a good point about lumber prices. That it is a decent correlation to where the housing market goes, or at least the pricing of housing, simply because the cost of input affects the cost of output. One aside that I'll note: we had lumber prices were down on Friday by 4.5% because the U.S. dropped some tariffs on Canadian lumber, and they may be doing so some more. That was from the National Association of Home Builders. When you talk to the home builders, basically what they're saying is they expect real estate to hold its own, but only go up small, like 2-3% a year. They're not expecting a collapse, but they're expecting the market to come back to equilibrium as demand is sort of sated, if you will, and that more and more inventory comes on, and that takes time. Um, there's still a big gap between the starter home and affordability for younger people, and it's a big problem when you look at. There was a time when a starter home was 150 to 250,000 in the Northeast, and now I think it's probably between 3 and 400,000. And it's with the jump we've seen in mortgage rates, we've definitely seen the housing market slow. And a lot of it, that's also going to depend on the Fed, just not inputs of commodity prices. How far the Fed goes, how far they push up rates, how much they cost of borrowing. I know from some friends who are real estate agents that deals have cratered over the last 4 months or so, because the move up in interest rates, when they got to the table, it increased the monthly mortgage payment for some people beyond their capacity. And basically the banks were just pulling back, or the buyers were pulling back. So there's always that out when you do to close a real estate deal. If you can't get a mortgage, no one can hold you to it. And both sides are sort of having difficulty getting mortgages. The banks are having more difficulty lending because the consumers are just not as credible, and the consumer can't borrow because they don't have the disposable income to meet the payments. So I think in the long run, real estate will hold, and I think it will not weigh on the equity market, but that remains to be seen.
So this goes back to Job One's discussion around treasuries and the long duration side, because if you have weakening housing, that should be bullish for long duration price lowering of yield, because 30-year mortgage rates, the demand for money drops if housing is not going to be as appealing or affordable, right? So that should result in the cost of capital on the long end responding, which I think partially explains the move off of the low in price, top in yield that's happened intraday June 16th, which I've noted before was the same day that U.S. small caps bottomed. So in other words, June 16th intraday, both treasuries and stocks bottomed at the same day, which I think is interesting, although maybe to be expected, just because they both sold off. So it kind of makes sense that they'd both have a relief rally. Now the question then becomes, and I want to hear your thoughts on this point, Vincent, that I've been talking about this a lot as sort of, and I've shared in the top of the space here something of a lot of people have already seen, but this point that what we saw this year was very abnormal in that usually when you have a big drawdown in equities, treasuries actually benefit.
Correct.
Instead, treasuries looked like equities, meaning the drawdowns were wildly correlated, right? Which is unequivocally, factually a historical anomaly. The question where I'm going with this is, I've had some people say to me that this would suggest that because you're in an inflationary recession, the relationship of treasuries to stocks, treasuries as a hedge, is broken. What are your thoughts on this idea that treasuries may or may not be a safe haven again?
No, I don't think it's broken. I think I mean it's been dinged primarily because of the what we've seen in the last 2 years in the markets in terms of the gyrations of enormous fiscal stimulus to meet the pandemic, a Fed missing a rate cycle, too much money sloshing around. There's still too much liquidity out there, which I think in the long run is going to be positive for treasuries. I think that the trade going into 2023 for me, and it's still too soon because the Fed's not there yet, is going to be that reversion. That if the equity market does go down, the treasury market will be a good place to be. And I think it'd be the great place to be is inside 5 years, and especially the 2 years. Because if the economy rolls over, the Fed's just not going to stay at pace. And the reason why we're looking at a 3% 2 and 5 year is because the Fed is expecting to raise rates towards 3.5%, maybe even 4%, as Mester had said on Friday. So you simply can't have a 2 year or a 5 year yield if you're looking at a 4% overnight rate. But I don't think personally that we're going to actually see it that high. We may see it there temporarily after September. But if the economy rolls over, which at least the pricing out on the curve shows you, the short end can't stay there. And so that inversion will go away. The short end of the bond market is going to be probably a very good investment, a good place to be. And at least in the short term, I think it'll be good for the equity market because they'll see rates coming off. those correlations, as we said before, about where the dollar is with the equity market, that's going to break down, and it's no longer going to be helpful. And this correlation, which did break down, will eventually revert. It's always a matter of timing. It's impossible to pick the exact time. How long can you stay in a trade and lose money until it comes back is always the bottom line. But at the end of the day, I don't think the economy has changed through this pandemic so drastically that we're going to throw away that historical correlation. It's going to be difficult in the short term to use, as we said, the participation rate maybe to gauge jobs. But inevitably, that's going to come back as well as things get closer to normal. But normal's still far away.
No, and it's really around that causation. I've had so many people say to me, oh, you should be doing less of these spaces or tweeting less and re-optimize your approach. And my response is, why would you re-optimize when you're in what is clearly an anomaly? And even if you were to re-optimize based on the anomaly, you're making the assumption the anomaly persists and that causation is broken. I think this is why a lot of traders, to your point earlier, have been having such a hard time, because you have some kind of research, some kind of indicator, some kind of approach that historically, more often than not, on average, quote unquote, works, right? And you're in a period here where a lot of things are not working, a lot of things are desynced, and people say, well, then you should change your approach. But that seems like a bizarre way of approaching tomorrow, because that assumes that it's going to persist tomorrow. It may not.
No, it may not. I mean, when you talk about correlations, you had mentioned earlier the dollar and commodities. Well, oil prices are up and the dollar is up because of the situation. At least, let's face it, we did have a situation where we pulled back on domestic production drastically, and so there's a great deal of investment pulled back because we're expecting to be out of fossil fuel by 2030, which is nowhere near going to happen. We obviously had the situation with Ukraine. Which has hurt oil prices. But WTI's come from 110-ish down to below 90. That is not an indicator of inflation and an expectation that the economy is going to grow rapidly in the next 6 months. There's a side of that oil calculation, which is demand. It's not just supply. And clearly, markets are seeing demand drop or expecting it to drop drastically to bring that price down dramatically. I don't see us going back to $100 WTI unless Russia just turns everything off. And I don't think that we're in that situation geopolitically. As you go forward, the price of oil may hold up because, when you start to parse your disposable income, and if you're in the lower income group, well, you obviously have to heat your home in the winter, and you could do away with, getting your hair done, for argument's sake, just to make a silly comment. But at some point, if you can't look at that commodity and say it's all supply side driven, and if it isn't all supply side driven, clearly oil traders are telling you their expectation for robust growth for the next 6 months is not that great.
Yeah, and I will say that kind of goes back to that June 16th point. I don't find it a coincidence that oil peaked about a week and a half before the June 16th low in treasuries and stocks. I don't find it a coincidence that energy stocks peaked before that June 16th low. I shared in the tweet this point. Every time I hear this line that the Fed has inflation under control, my response is, it's not the Fed has inflation under control, it's oil has inflation under control. Because talking about correlations and causations, break evens are very tied to the movement of oil. It's not an opinion. This is just historically, you look at tips relative to nominal, that's pretty much your way of seeing what oil prices are doing and vice versa.
Yeah, and again, you talk about correlations. I think the correlation, with the inverse correlation that we saw with the dollar and commodities, is probably going to be dead for a little while longer, because if you see oil prices come down, it wouldn't surprise me even a little if the dollar came down also, because you'd be seeing this move into risk, away from haven, if you will, which is what the dollar has been. When you talked before about treasuries underperforming, I think part of that underperformance is because the dollar's been such a good place to hide for a haven, and has maybe stolen some of the thunder from the Treasury market. But I don't expect that to persist. At some point, when the world turns itself right again, and risk is trading in a more normal space, you're going to see the Treasury market be attractive again, the equity market be very attractive again, and the dollar won't be necessary as a place to hide. And maybe that's a great indicator to look at going into 2023. That if the dollar turns, that's the all clear signal to seriously get back into risk. Yeah, I mean, it's a really good question. And I think if we had history as we've seen it, and without the last 3 years kind of mucking things up, your analysis would be bang on. What I'm seeing, and so um, again, I'm going back to the demand side of this equation and not the supply side so much. Everything I look at the U.S. consumer, and this is the average consumer, not obviously the well-to-do. Average hourly earnings are up 5%, but inflation is running 9%. The savings rate's back down to where it was before. Revolving credit is probably at its highest level that we've ever seen. It seems to me, Christmas spending taken out of the equation, that the next 4 or 5 months, the consumer is not going to be driving this economy as we have seen the consumer do so and need the consumer to do so. So my expectation from the inflation standpoint is not so much being driven by the fact that prices are high, and energy is obviously a significant component. It's nice to see the Fed coming back to CPI and getting away from PCE, by the way, and that real people have to worry about food and energy prices. I think those things are coming back, and food prices actually is just another point. One of the things that's even been more significant than energy prices in the last maybe 6 months to 12 months in terms of inflation has been the rate of change in food prices. That's starting to moderate also. Things are getting a little bit better in that front. So my feel is that that equilibrium is going to come back. Maybe not as fast as the Fed would like it. And I'm be sad to see them be so in a hurry to bring it back to equilibrium, because I just really, really feel it's going to come back by itself. That's all. And that the Fed, at least in my opinion, is once again on the verge of making a very big policy mistake. Yeah. Oh, absolutely. Medical equipment is another big thing from Germany, and then we have no idea what's going on in China, conducting military exercises this weekend, which are mimicking attacks on the main island of Taiwan. I would seriously hope and expect that no one's going to do something silly in the South China Seas and in the Strait for Taiwan. But there are so many things that could disrupt the status quo and cause that supply chain to again become even a bigger worry than it was during the pandemic. I mean, we're in terms of being equal with supply and demand. My only point to that, or the point that I'm sort of hanging my hat on, is not so much that the supply chain is going to get back to normal as quickly, but that demand is going to drop to match it, or get closer to equilibrium and take the pressure off inflation. But if something happens to disrupt the supply chain, and the geopolitical risk is enormous in that space, then all bets are off, because then we're back to maybe even a worse place than from an inflation standpoint than we were before.
Let's do yeah, let's try, and let's do two more questions. And by the way, everybody that's asked questions, I do appreciate each one of you coming up and helping and engaging. I think that's what's so great about these kind of conversations. And please, again, everybody in the space, make sure you follow Vincent on Twitter.
My hope and my belief is the recession will be somewhat shallow, and 2-3 quarters, and not significant in terms of lower GDP. Simply because I think the Fed will back off considerably, and it's an election year. So we'll probably see a fiscal response that we probably don't need to see, but we will see.
Just stop inflation act. Sorry. Sorry. Something in my throat. Sorry.
Yeah, I'm going to throw out all my textbooks when people tell me if you increase fiscal policy, fiscal spending, that negates inflation. I'm hoping very much that I'm right, and that we'll see a relatively shallow recession because of the where we had come from, that there was a huge cash infusion from the fiscal government, that a lot of spending has been done. You don't see an entire economy having to rush out tomorrow and increase durable goods spending, because they probably had done a fair amount of that during the pandemic. So fingers crossed it's a shallow one. How we come out of it on the back end is going to be quite interesting, and how long it takes is going to be interesting.
So
The
this is
risk
a
is
great question
there.
because this has been bothering me too because and that relates to the earlier. I don't recall if you were here or not, Tracy, but this point that so if the dollar does roll over, you've had commodities strong in the face of very strong dollar, which is historically abnormal. Then if you suddenly have the dollar weaken, well, that's actually supportive for commodities.
You make a very good point. I am actually in your camp. I think the dollar. I unfortunately thought the dollar peaked about 60 days ago, so I was a little ahead of myself. But I think we're very much nearing a point where the dollar is going to roll over for a variety of reasons. Now, what that does to inflation is really going to be interesting. It isn't by itself um, necessarily going to increase inflation substantially, depending upon what the other inputs are. One of the first things that you're going to see is large cap equities rally considerably, because I know, as I've covered these people, they don't hedge. And so you're seeing all these losses, or reductions, I should say, in earnings estimates from large corporations, and all blaming losses in FX because they don't hedge. Now, they're probably not going to change their tune anytime forward, because they're all going to sit there and basically wait for the dollar to turn over. But when it does, it's going to add a considerable amount of weight, I think, to the equity market. And that return to risk and some inflation, um, hopefully will bring us back to a supply side balance of things, because there'll be more earnings to create more supply. And the dollar's impact on inflation won't be as dramatic, as, say, what it could be in typical times. Again, that's it's kind of a roll of the dice, to be perfectly honest with you, but because it's just not the only component. The other things have to fall into play. But I do agree with you. I think the dollar's definitely run its course. It's it's been going up again, as I think more in many ways as a haven rush, both toward inflation, both toward not being able to get into equities, not really feeling it in the bond market because of the sell-off. Inevitably, I think those correlations will revert, and I think we'll see a lower dollar. How it impacts commodity prices, if it's drastic, then it's a problem. If it's moderate, then I think we're going to be just fine. Without question, absolutely. I tell that to people all the time. You want to just say it's a strong dollar. It's actually very much a result of weak G7 peers, and also emerging markets. When you get higher inflation, EM is not the best place in the world to be. It puts a lot of pressure on their economies. And the movements that you look at, for instance, the Chilean peso above 900, and where the Brazilian real now is at 5 and change. I remember when I was at Santander, just a quick story. A company in the U.S. was buying a company in Brazil, and they were buying Brazilian real at around 150, 160. And we begged them to hedge, and they refused to. And that later company was acquired by another company because they lost so much money.
Yeah, no, that's and again, everybody here, please make sure you follow Vincent. I think this is a phenomenal conversation. Hopefully, Vincent, you and I will get together again, not at a conference.
Hopefully.
Like did whatever it was 8 years ago. But again, everybody, please make sure you follow Vincent. Real pleasure, Vincent. I'm glad we did this.
My
And
pleasure.
everybody,
Thank you.
yeah, and everybody enjoy the rest of your day. Thank you, everybody.